All right, let's talk Humana. The company just dropped its latest earnings report, and it's one of those releases that sent some seriously mixed signals. On the surface, some numbers looked pretty good, but then you see how the market reacted, and that tells a whole different story.
So here's the big puzzle we need to solve. Humana comes out, they beat Wall Street's adjusted earnings estimates, and the stock just tanks, down a sharp 7% before the market even opens. So what gives? What did investors see that made them hit the sell button so fast? Well, we're going to dig in and find out.
Okay, so let's get right into it. The whole story really starts with these headline numbers. And honestly, it's like a tale of two completely different earnings figures, pulling the narrative in two opposite directions.
Just take a look at this contrast. You've got adjusted EPS, that's the number that strips out some of the one-time items to show you how the core business is really doing. It comes in at $3.24, a really nice beat. Revenue also looks good, coming in a bit ahead of what everyone was expecting. But, and this is a big but, you look over at GAAP EPS, the official by-the-book number, and whoa, $1.62. That's a huge miss. And this slide really lays out that core conflict, doesn't it? On one hand, you have the beat, the adjusted number that, let's be honest, companies love to talk about. But on the other side, you have the miss, the official GAAP number that paints a much less rosy picture. This split right here, this is where all the market's anxiety started.
So you've got this mixed bag of results. What does management do? Well, they came out with a very clear playbook. Their message was basically, hey everyone, ignore the short-term noise. We're playing the long game here, focusing on stability and creating real long-term value.
And the CEO, Jim Reckton, he spelled it out himself with this quote. What he's really saying here is that they're shifting gears. It's not just about getting more members in the door at any cost anymore. It's about finding the right members and building profitable, sticky relationships that last for years.
So their whole case really boiled down to a few key points. They're telling us, look, our new pricing is starting to work. We're finally getting a handle on costs. And hey, our big growth areas, CenterWell and Medicaid, they're really starting to take off. They even bumped up their outlook for Medicare Advantage members, which is a great sign for retention right before that critical enrollment season. Okay, so management is painting this picture of confidence and long-term strategy. But clearly, the market wasn't buying it. So why not? Well, the answer, as it so often is, was buried deep in the company's forward-looking guidance. You had to read between the lines. And boom, this is what happens when investors read between the lines. That 7% drop, it tells you they found something in that guidance that completely overshadowed the good news on the adjusted earnings front. Now to get what they were so worried about, you got to understand this one key metric, the insurance benefit ratio. It sounds complicated, but it's really not. It's just the percentage of money they get from premiums that they have to pay back out for medical claims. It's a direct line to profitability, and the key thing to remember is lower is always better. And this was the number. This is what caused all the damage. Management guided that for the fourth quarter, their benefit ratio would be around 93.5%. To Wall Street, that is a massive red flag. It screams that margins are about to get squeezed and medical costs are heading in the wrong direction. And if that wasn't enough, they also did this. They took a knife to their official full-year GAAP EPS guidance. Slashed it. Now, sure, they kept their adjusted number the same, but cutting the official profit forecast like that, it just threw more fuel on the fire for anyone worried about rising costs. But okay, let's not get too down here. It wasn't all bad news and scary guidance. There was a genuine, really important bright spot in this report, and that was the CenterWell division, which is basically their growth engine right now. I mean, just look at these numbers. CenterWell is absolutely killing it. Primary care patients are up 15% just since the end of last year. That is fantastic growth. This is exactly what you want to see from their diversification strategy. It proves they're not just a one-trick pony. All right, so we've got the good, we've got the bad. What does it all mean for the stock? Let's put it all together and figure out where Humana goes from here. It's time for our forward outlook and the final rating.
And here's how we're going to do it. First, we'll look at the key things you absolutely need to watch for in the next quarter. Then, I'll give you my prediction for what the stock's going to do. And finally, we'll wrap it up with our official rating.
So if you're watching this stock, here's your checklist. Number 1, without a doubt, is that Q4 benefit ratio. Do they hit that 93.5% number? Or, even better, do they beat it? That's huge. We'll also be looking for updates on enrollment, making sure CenterWell keeps up its amazing momentum, and listening very, very carefully for any hints about what costs might look like in 2026.
So what's my call on the stock price? I think it's going to be stuck in a trading range for a little while. Look, the market has a long memory. It's been burned by rising medical costs before, and it's not going to jump back in until it sees hard proof, real data that Humana has this thing under control. Until we get real clarity on where costs are headed in 2026, I just don't see a big move up.
And that brings us to our final rating, market perform. It really is a tug of war, isn't it? On one side, you've got them executing really well on those adjusted earnings. And you've got the CenterWell growth story, which is fantastic. But pulling in the other direction is this huge, unavoidable uncertainty about margins and costs. Until that cloud lifts, we think the stock is just going to perform right in line with the broader market. Not great, not terrible. Just market perform.
And of course, I have to say it. This analysis is for your information only. This is not financial advice.